Okay, I was asked to do a real quick video on Karen the Supertrader type trades. So it's really easy. Actually, it's really simple what she's been doing. If you watch her videos, okay, let me clarify that. I said simple, not easy. Okay, because she's basically um, doing simple selling simple naked puts and naked calls on the SPX. Now, in the first video, when there was more volatility, she was selling them around 2 standard deviations. And then as volatility shrank, like the last year or so, last 2 years actually, what is this? 2013 was a lot harder, but she did them closer to 1 standard deviation out of the money. So let me just show you, I'm assuming you folks have all experienced with those. Let me just show you what I mean visually. So well, you know what? I'm just going to go basic. So you sign up to Doe, and let me show you what I mean. You click on trade, you type in SPY, hit enter, okay? And this trade will come up. So let me show you what she was doing. This is all she does. Actually, she does SPX, okay, which is a much larger contract. For most of you, you'd be doing SPY. Or I guess you could try it. I guess I'll just show what Karen is doing on the SPX. Hold on, let it load. Now, okay, so all she does is she's saying, and she's kind of a contrarian, meaning, and she would, contrary to popularly, she wasn't really doing strangles or iron condors. She actually treats each side of the trade separately. Here's what I mean. If you go to choose strategy and you go to strangle, she was going 2 standard deviations out of the money. So first of all, she started out 56 days to expiration. So make this 56 days. And then she would go 2 standard deviations out of the money. Click on monthly, okay, and then hit go. Okay, so you know what, I better go back. For new people, basically strangle, you're going to do a short strangle because that's my default, because you're selling something, right? Every time you see short, you're selling something. 56 days, okay, here we go, monthlies. Click on 2 standard deviations and hit go. Okay, so if you take a look, right, here we are 60 days, because that's the close to 56 days out of the money. The SPX, which is the larger SPX is trading at $1,919 per share. Okay, so if you sell a strangle 2 standard deviations apart, see this 2 standard deviation line right here? I don't know, I guess I could move it over a little bit. There we go. Yeah, these. Okay, if you just sell one, you have a 95% chance of making money. If you sell both, okay, here we go. Here we go. Your probability of profit is 96%. Now look at each one. Oh, I'm sorry. Click on the leg. Click on where it says leg, and it'll change it. See, watch here. What this is saying is this side, you're selling a put. That means you're betting that the S&P 500 will stay above 1,675 at the end of 60 days. And for that, you're going to collect, or you're going to sell it for $6.15 or $615, okay, per contract. $6.50 per contract. Each contract is worth 100 shares, so it's $610. Okay, so you're, in this case, you're betting that the S&P 500, which is here, will stay above this number at the end of 60 days. Okay, now on the call side, you're making the same bet. You're betting that it'll stay below $2,200 at the end of 60 days. That's why everything in green, if the S&P 500 stays within this level, you make money, okay, at the end of 60 days. What are your chances of making a profit? Right here. Okay, now let me zoom out. Everything in red is where you lose money. So if the S&P 500 shoots past up this, okay, this is where you lose money. If the S&P 500 drops down below here, this is where you lose money. Okay, now if you want to check on the leg, see this right here? Click on this leg. There you go. So each position has a 98% chance of probability of finishing out of the money. Oh, by the way, what does out of the money mean? The chances of it staying in above this is 98%. Chance of staying below this is 98%. Okay, and that's the gist of Karen's trade. But here's what she does, though. By the way, so I'm going to clear this. What she does is she doesn't do both at the same time. Okay, what she does is if the markets, if the mark like today the markets are down. See, it's down today, right? So on a down day, she would sell puts. Okay, so meaning if the market's going down, she'll enter a trade that the market will rebound higher. If the market goes up, she's been entering call trades, and she does both. Okay, and then she just watches them. So here's what I mean. I'm going to go to choose strategy, and I'm going to go straight to option. So because it's a down there, we're going to sell a put, right? And she does 56 days, so I'll change this to 56 days from 45. Okay, and here's what she does. And she goes to 2 standard deviations out. Okay, well, that's what she used to do. She said she'll do it again when volatility gets higher. Look, it's at 51%. S&P 500 hasn't been this high in a long time. Okay, so I'll scroll it down. See, so look what she's doing. She's betting that it'll stay above this level, okay, at the end of 60 days. Now, here's what she does. Okay, she manages her winners. Right, so look, she has a 99% chance of being right. She's collecting $5.50. So could you. Okay, but look at your buying, by the way, but you got to have, in her case, it works because you need a lot of money, because here's why. Look, the max she can make is this, but she's going to risk $166,000 to make $550. And she, of course, this is an IRA account I'm showing you here, but she has portfolio margin, so she has a lot of money to work with. Okay. Okay, so back to this. So that's what she does. Now here's what she does. As every day goes by, she'll buy them back. So she'll sell them for the. If she can make some money, she will she will churn it. So put on a position, sell it, buy it back. Put it the same one back on, buy it back. And she does this all the way till this gets to about 40 days left to expiration. And then she usually just leaves it on to, and it expires worthless, meaning worthless to the other person. And she collects all the money. Okay. Now, click on this. Oh, I'm sorry, wrong one. Click on leg. As far as management wise goes, how does she manage it? If you listen to her last video, or the second or third one, I can't remember, either one. If this position, if this starts to get towards 70%, okay, so let's say, just for the sake, let me move it up here. So let's say if I'm just kind of fast forwarding in time right here. So let's say it's like right around, yeah, right around here. Okay. So let's say the S&P 500 in this case kind of dropped down, and now it's around 70%. This, and then, and let's say she has, I don't know, 45 days left in the trade. Okay. She's not going to ride it out. What she does is she closes this position. She rolls it. She, within the same month. Okay. So she will close this position, right? Take the loss and sell another position 80% out like this. Okay. So she took a loss of so much dollars. She's selling again more premium, so she collects more money to make up for that loss. And then she might double down, meaning let's say you lost, I don't know, $100 or whatever it is, right? So she puts on, instead of one contract, she'll put on 2 to make up the difference. Okay, or, oh, I'm sorry, and as well, to make up that difference, she'll sell more calls. Okay, so she goes, okay, well, how can I collect more money? The market's going down. The market went this way, down, and I don't want to go in the money. So she's going to sell her 70% probably out of the money and move it back out to 80%. So she still has a high probability of success, and she's going to collect, more money for that. At the same time, okay, you grab the call button, see where it says September 30, 2014 quarterly. Oh shoot, I was wrong. It should be a weekly. I mean a monthly. It doesn't matter. Just for illustration purposes. So you'll just remember this. Remember this date right here. You grab the call, and she might go like this. What did I say? What was it? September something quarterly, right? How do I get to that though? I'm looking for. Oh, I'm sorry. What am I doing? September something quarterly, which is down here, and I can't get to it because I don't know how to get down there because I don't usually do it this way. But there must be a way to do that. Okay, you can fix it by dragging it again. Okay, see, it's the wrong one. See, it says the weekly. I want this one. So just grab it again and oh crap. Okay, here, you can just double click it. I'm sorry, just double click the position, it'll open it up, and I'll just select the day, whatever, just to match. I'm trying to get it to match this. So September 30 here, I think it's this one, right? Yeah, there we go. See, it's done. So click on done. Okay, so 60-day quarterly, so it's the same. All right. Anyway, so remember now, let me click this out. This position got tested. It was like all the way down here, like 70%. She doesn't want to wait. She still has a 70% chance of making money. She doesn't want to take the chance. She closes it and rolls it all the way up to at least 80%, right around here. Okay. And then, so she collects 20 bucks more, whatever it is, right? But then she also grabs some calls and then sells some calls, more calls, to make up the difference from the money she lost from the last trade. Okay, that's all she does, and then she churns it, and she churns it, and she does it again and again and again and again and again. All right. So in our case, unless you don't have that kind of money, so we'd be doing the S&P 500. Okay, and since you don't want to, we don't have, or you can't do that in an IRA, or if you have a tasty bite-size account, what you've got to do is you've got to sell wide golden geckos. All right. So here's what a wide golden gecko looks like. Right. You click on Iron Condor. You make this is defaulted. Right. You're gonna choose 56 days like her if you want. Right. Monthly. Right. And you're gonna click on 2 standard deviations. Okay. And then you're gonna hit go. And over here, you want monthly. So the first example I screwed up. So all you want to do is just click on expiration date up here, and you can change it to, oops, wrong way, to you're looking for the September 30th monthly. Here you go. See, 49 days. So perfect. So look, see, we are 2 standard deviations out of the money. See right here? Okay. And now we want to move these. Now, because we don't have the capital she does, we can see if I can, there we go. And you want, oops, too much. You want this right on that line, and the buys you want to move them out to simulate a synthetic strangle. All right. So, but look, see, the problem with this is you and I can only collect 24 cents. We can try to move it out a little bit. You know, get this down to like really cheap, like a penny or something, or 5 cents. See, now look, we can create. You know, look, that's pretty good. We can collect 56 cents, and look at our chance of being right. Let's zoom out a little bit. Yeah, it's not really changing much, is it? Okay, so we can even push it out more to get this down to a penny to try and collect more. But notice as I do this, we collect more. Okay, that's a penny. The wider I go out, the further I go out, though, the more capital I'm using. Okay, so look, here we go. I'll zoom in. I'll try to zoom in one. I doubt it'll work. Yeah, it's too far out, so you guys can't see. All right. So see, it's this green area is where we make money. Okay. So this is what a golden gecko would look like 2 standard deviations out. Look at our probability of being right, 96%. We can collect 53 cents. Look how much money we're tying up. So click on the middle button. We're going to risk $5,000 to make 53 bucks. Okay. This is what Tom says he wouldn't take that risk. But Karen the Supertrader is a numbers person. If you could place a bet that you're going to be 96% right, 95% right, how often would she do that? If you listen to her, she'll do that all the time. Okay. Now, but she doesn't do both the put side and the call side at the same time. She does it one side at a time, or you know, she manages the puts and call entirely independently. So you can watch. You can double click this, okay, and you can delete it. Double click this and delete the call side. Why? Because the market's been dropping. Okay, so she would be bullish. She'd be betting the market would go higher. And because volatility is so high, okay, we can just sell 1/2 a golden gecko. So a put spread, we can sell a put spread right here. Okay, I got a few more seconds here. All right, so look, we can sell just the put side and we can collect 53 cents on the SPY. How much are we risking? 5 grand to make 53. You want to reduce this capital? Simple. Click on that, right? You have a 99% chance of being right. If you want to tie up less capital, you got to drag this in. But look what happens to your premium amount. It goes down. You're not going to collect as much. But then again, so you risk less capital. Okay? And that's all she does. Now, how do you manage this? Same thing, right? What if this gets down to like 70%, you know, and you've got still like 45 days to go? What would you do? Same thing, right? Roll this position, right? out to where you get at least 80,